It's a big week for markets. It's also a big week for what's happening with the Fed and also Capitol Hill. We're going to be breaking down all of that stuff for you guys today. And we're going to hopefully take you into two different live streams, what's happening with Chair Powell and also what's happening in DC right now around the crypto bills. Break all that down for you. My name is Paul Barrow. Welcome back into Tech Path. Of course, now we've all been waiting on the FOMC today. This is a normal process. Short and quick, 25 basis points is the hit. So we are seeing another rise in interest right now for the Fed fund rate at 25 basis points. Likely is that, and many people have been anticipating this, is that we could see another quarter point even through the next few months, all the way into the end of the year before we start to see some softening. And I think pretty much everybody that we had looked at, I was just kind of scanning some of the tweets that were previous of this. This, of course, was TED Talks Macro. Despite the data, the Fed still project higher rates to year end, telling us we may have two more 25s. I think everybody's pretty much on that bandwidth, and I don't think anybody really was worried about it. Now, some things that were playing into this is not only how, but what the PCE and traditional inflation continues to fight it out. Because if you look at where PCE is, PCE and ECI are not sticky, but the PCE is well above the Fed forecast at 3.25. So inflation right now, there is some play in it. And I think the big factor here is a lot of what's happening on the macro markets of how this may affect some of the data that the Fed always talks about. We are going to be cutting to the Chair Powell here in a bit and listen to him basically break it down on the forward-looking statements. This is basically whether or not we'll see a dovish report or a hawkish report or something in the middle. I'd love to know your thoughts. Make sure and smash the like button if you do like these live restreams that we do. And then also, if we get a chance, right now on the House floor, there is a hearing going on, or I should say a vote going on. There's been a handful of amendments that have been proposed to the crypto markets bill that basically is in play. Tomorrow we have the stablecoin bill, which is Maxine Waters. There were some interesting things and statements around that earlier today from Maxine Waters saying that she felt very confident about that one. But we've been watching this all day, and I mean, it's hours and hours of amendments being struck down, amendments being pitched. One amendment that ended up actually getting approved in the cycle. And of course, remember, this is the committee that will basically send this bill to the House floor. If we get a vote while we're live today, we'll cut to that for you guys so you get a chance to see the actual vote that would send this bill to the House floor. This would be pretty groundbreaking, and it also most likely, for those who are following this, will probably get a chance to see some market action in all of that for sure. Let me kind of jump over to the charts real quick. Of course, right now I'm looking at ETH. Starting to move a little bit. We're on the 15-minute. Obviously, the quarter point, I think a lot of people were worried that is there going to be some other scenario, and this also is the pre-Powell speech that he always gives where the reporters come in and ask questions. Bitcoin also slightly up as well after it had a nice little red candle right before. And this is on, as I said, this is on the 15th, so we're hovering right around 29.3 currently right now. Sentiment has been kind of back and forth on ETH and Bitcoin this week, even though it has still slightly Bitcoin trending up, which is unique, especially under conditions that we've seen here within the markets. A couple other tweets here I wanted to hit on. This was an interesting one that I'm still a little bit perplexed about. This is from BlackRock's report of the 2022, the optimal portfolio in terms of risk versus reward. And I would say, okay, that's the key statement here, risk versus reward. And they're saying, hey, listen, if you want risk versus reward, this is the number one asset to go into. Bitcoin at 84%, stocks, then bonds. Significant for those who are willing to truly go out on a risk asset structure and also on a strategy. And I think most of our audience and listeners, viewers are probably already in that camp. But I'm kind of curious. Drop some comments over on the side what your balance is. If all things are right and we start to move out of this bear market, where would you be in position to your holdings? And I'm just talking about all crypto holdings, if you just hold Bitcoin, if you're an altcoin guy, a degen token guy, let me know where you would stand. Would you be above the 50% mark? Would you be below, or would you be in this range of 84, 85%? Another tweet here. This, of course, was the predictions, just showing everybody was kind of on it. This, of course, was Trade Rocco coming in at 25 basis. This is the interesting point, though, and I think a lot of people will kind of address this as well, and that is this whole issue of how Powell responds to these things. Now, in many cases, I think sometimes he has a script when he goes into the meeting, and then the reporters sometimes throw him a little bit of softballs, and then somebody will come in with some fairly hard questions or some straight point questions. And I think the big one right now is how the market is going to respond. If you think about the S&P, what we'll start to see within that, I think, is a bigger factor. Let me kind of go to some of the markets real quick, and we'll get to that in a sec and get into that. As I said, go ahead and drop some questions in over on the sidebar. We'd love to get your feedback. Yeah, we're still running slightly up, right around 45.50 right now on the S&P. So interesting. Not that we'll see massive movements here, but the point is that Powell, of course, is going to have to do something to continue to suppress what's happening in the open markets, which I still believe is the Wall Street insiders. It's not traditional, Home Street, Main Street Americans, because that, I think, has started to see a little bit of effect on Bidenomics. We're going to be cutting to the Powell's press conference here in a few minutes. He usually comes on right at 2:30. We'll get a chance to do that. And we're also monitoring what's happening over on the House floor right now, which is crazy. I mean, we've been, as I said, we've been talking about that and watching it all morning. And there was times when the House floor, let me jump over to the Bitcoin chart real quick so we just kind of watch that and make sure. The House floor was very interesting today because we saw, of course, the new nemesis, I think, of crypto in general has been Mr. Sherman, which we've shown many times on our show. He was the one that was really pushing against the grain. Now, in the beginning, it looked as though that the Republicans were losing a little bit of ground, but towards the middle, right before their recess, that happened about, I'd say, 30, 45 minutes ago, the amount of amendments that were being thrown at the bill were actually being struck down on the floor of the House in the committee meeting. And the way this works is this committee meeting that these members will vote on, this essentially moves it to the next level, which is going to be a vote on the House floor. The question would be amendments possibly make it there. I'm not sure how that process goes when a bill actually makes it over. Maybe this is where those amendments would be coming in. We had Ron Hammond on from the Bitcoin, or I should say, Crypto Blockchain Association last week, and he and I kind of got into this topic, and he did a good tweet stream today. I retweeted. If you guys are following me on X, go out there and take a look, because there was a few points in there that he hit on that were very significant. And another thing that was very significant in that area was this whole issue around the XRP and Ripple ruling. In fact, it was holding a lot more weight on the House floor. So it is clear that our lawmakers are depending on that ruling in a very big way. Now, this is very interesting on timing, because with that ruling literally in their bag before they go to a House vote, this could really sway a lot of not only Republicans, but possibly some Democrats. I mean, Democrat Richie Torres, we already know who's very prominent and has been a outspoken policymaker on this, very, very much in line with what the Republicans are going in. And remember, this is a bipartisan bill that came in from two bills that were being merged into what we're seeing now. Again, Maxine Waters' stablecoin bill is the one that we think is most likely the most important. Now, I don't know what kind of impact this will have on Chair Powell. I think his concern right now is very clear. We've got to get a continuance of inflation sliding, and we have to get into a position where we don't have the markets in turmoil. The challenge is you've got so many very unique scenarios playing out, with the fact that we already see the traditional securities markets continuing to climb. You see commercial real estate declining, and you see jobs maybe for the first time starting to waver. Inflation, though, on traditional inflation, not core CPI, but it starts to be in a position, I think, where, again, a lot of people are starting to feel that pinch. And that typically is kind of that Main Street effect that does affect elections a lot more. I think inflation will continue to be on the minds of most of the voters next year, especially if this rolls through to the first quarter and second quarter, as a lot of candidates can campaign, because I think this, even though I think it'll be out of the woods by the time we get to a presidential election. A couple other things I wanted to hit on. This, of course, was Tim Draper saying Bitcoin will rise, of course, above all fiat, and it's better and safer than banks and government controlling currency. You got to remember, Tim Draper is a Silicon Valley insider, has been one of the leading Silicon Valley investors, VCs, for the last really 3 decades. I'm a little surprised at how strong he has come out. We're hoping to have Tim on our show in September, which is our plan. We've got some things happening in September that I think will be very critical to have his voice. But very interesting there. We're definitely seeing a lot of tactics coming in from Silicon Valley. All right, this was just kind of showing you U.S. core CPI still 4.8%. This is the one that is the more sticky one, that isn't necessarily the one that the Fed is watching, which is around the 3% range. And if they can get into that core 3, how long they can hold or achieve 3 for what period of time is the question mark, which is why I think still everybody is still anticipating that we're going to see another quarter point coming in. Let's go back to the Bitcoin chart just to see where we are right now. Bitcoin's still coming in. We're on the 1 minute. Let me go to the 15 minute here and see. Yeah, so pretty much still painting a red candle on this next 15 minute here at 29.2, holding that right now. Love to get you guys' feedback too. Do you feel like this today, looks like Pal's coming on right now. Let's go ahead and cut to that feed. Here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
All right,
Mr.
so
Chairman, thank you.
Seems fairly confident here.
You have, I think, a couple times in your opening remarks talked about this
See if
language
the
in
press
determining the
grills
extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting. and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't
answer
know
this
that
is
until
really
we see the
talking
data.
about
So
this whole issue
we'll
with
be focusing on
CPI. If CPI comes in softer again on this next reading, we could see either a
Thanks for taking my
pause
questions,
or
Chair Powell.
possibly.
Obviously, you upgraded the language
Continued
around
pause
growth
throughout
in
the
the
end of the
statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS look good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, you know, how much of this and how much of that. You know, we'll be looking at everything. And, you know, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports.
All right, so he's
lots
kind of
activity
deflecting here
data.
on this. The point is that I think
And
he
that's what we're
seems a
gonna look at.
little
We're gonna
bit
make that decision then,
dovish
and
right
that
now,
decision
which is good.
Could mean another hike
Definitely
in
not coming in
September, or it
overly
could mean that we
strong,
decide to maintain
but he's assessing
at that
data. I
level.
think
And
the last
again, the question we're
CPI
gonna
was
be
the
asking
one that has
ourselves
kind of
is
set them up as a good
the
position,
overall
but they
signal
know
that
that they
we
still
need
have
to
to have the
do, or
quarter
whether we
in
tighten
place
further.
to really
And if we
deal
get
with
that
what
signal
we're
whenever we get it,
challenging
and
to
that's
try to
the
get back to the
collective
2.
judgment of the committee, then we will move ahead. If we don't, you know, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that,
All right,
that
we're
the
gonna
public has that inflation.
Soften that for a minute. I mean, it looks like he's deflecting quite a bit here, but the point is that the U.S. House vote is in full strength right now. Another amendment has been drawn into the floor. It was accepted. It's kind of a semantic situation on the word or term innovation around how the SEC would be dealing with some of these tokens. All of this is going into this new bill. So likelihood is we're going to get a vote on getting this bill to the floor here in a few minutes, but we're going to cut back to the FOMC. Let's go there.
Risk of doing too much or doing too little. And, you know, I would say that, you know, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But you know, we need to see that inflation is durably down that far. You know, as you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. You know, there's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, you know, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Go to Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions.
All right, so we're going to get back here to this, but I do want to cut to the hearing also as they are starting to bring it in. Let's see what's happening over there right now. Nothing, still kind of waiting in. So another amendment actually got passed. They're going to carry these amendments into the bill, into the House floor, which is where the actual House will vote on this. And that, of course, will be a big one. I think if we do get this bill carried into the House, it will most likely pump the markets. Let's jump back over to the FOMC real quick.
So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved repeatedly.
All right, the good news is that this seems to be a little bit neutral, if maybe even a little bit dovish in the essence of whether or not we're going to get I think we still will see a quarter point, but that's still yet to be determined throughout the end of the year. The key here is going to be, and you have to watch this because it's going to be 60 days between FOMC meetings again, is this whole CPI situation. And the last report, pretty significant. This may affect the markets much greater on this next. So our mid-report, which is going to come up next month here in August, will be a very big one to watch. So interesting stuff. But we are still monitoring what's happening over on the House floor as well. So we should have some stuff for you guys. Don't miss that because it's going to be pretty big. Also, smash the like button right now if you like these kinds of videos. If you like us to do these live streams, bring in all this additional research content for you guys. Smash that like button right now. Let's do it. Let's get about 2,000 likes. Maybe we've got that many now. We'll see.
But I think
Let's get back
what
to
matters is the overall picture is of tight and tightening lending conditions, and that's what this sluice will say.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's
all right. So he's kind of dodging the wage inflation topic, which is really going to affect business more than any. The other thing is coming over from the House floor. They just put out another amendment that has been accepted. So we've got two amendments that have passed through as they're working through this bill. One was removing the word innovation, and the other amendment that came in late was to allow the SEC more time to be able to review projects and situations. Let's go back to the FOMC.
And the common thing is they come out with agreements like big pay increases like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not
a large amount.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make. Informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway, and yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical records suggest that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through, job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy. And we hope.
All right, so we're continuing to monitor what's happening overall on the House, which is very active right now. A lot of amendments have been flowing into the bill. Some have been denied, some have been accepted. Another one came through. Right now, it's currently being reviewed, and this looks to be a very interesting scenario, meaning that this bill could get approved by the committee and move to the House floor. If that is the case, that would be a significant, result of what's happening right now. And remember, tomorrow is the stablecoin bill, which essentially will be going through the same process, trying to get to the House floor for a vote. And remember, once the House floor votes on it, if we get a post or a yes on the House floor, it goes to the Senate for actually becoming law, and of course, obviously, finally to the president's desk for signature. All right, let's cut back here. Looks like McHenry is here. This essentially is feed coming in from the House right now as they continue to debate a lot of these amendments. And this is a scenario that really is playing out in real time right now, in the sense of not only amendments starting to be challenged. And here's the thing, the amount of amendments that have been put forth today, I would count them at probably 7 or 8 by now. Likelihood is we'll probably see a couple more. The good thing is most of those amendments that have been frivolous and silly have been absolutely struck down. So there is a clear underlying effort here that appears that this bill is going to get approval and get basically regroomed a bit and then moved to the House floor. If that is the case and people start to see this could be a scenario for some market breakouts for sure. I'm going to cut back to the Bitcoin chart right now. It's starting to fall off a little bit we're still on the 5-minute where it had hit right there at that 29.4, even though it did have a bit of a wick there. So kind of recorrecting here around the 29.2, which is where the market has been holding strong. Let me see if there's one more question coming in on him.
Of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control, and we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle-class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long, or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Urbanovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT, so to continue it. You depending on where you are in the cycle, things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps.
I think Chair Powell's taking a little bit of a victory lap here because we've never seen him speak this long. Again, this is, and you guys have been watching the chart. If you look at Bitcoin right now, obviously it dumped a little bit here, even though there hasn't been a lot of price action. The point being is that this seems to be somewhat dovish versus hawkish, a little bit less on where the markets are going. I think they are anticipating a possible dip again in CPI, which would really set up the end of the year in a very big way, meaning would we get that next quarter point on the next meeting? Remember, they have 2 more meetings before the end of the year, which is going to be, could be something timing here for how inflation, how the economy all nestles in, and also other timing that plays into this is these House bills. We just had another amendment that came in, again, over on the House floor. So lots happening over there right now. It's interesting that both these things are happening at the same time. Very critical to the future of crypto. I think the big one again tomorrow, we're going to be covering Maxine Waters and her bill on the stablecoin, which I anticipate is going to go through with flying colors. But make sure and smash the like button. Do you guys like these kinds of videos where we break things down, give you a little bit of our own analysis, some direction? We'll take a look at some of the charts, maybe do a little sentiment toward the end of the video today if you guys want to stick around for that. we'll get into that. If you have some questions, feel free to drop them in over the side. We may get to some questions over here as well. So let's cut back to FOMC.
Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Thank you.
Thanks very much.
So that was it for Chair Powell. We are going to get you guys over to what's happening on the House floor as well, because this one I feel like is a much bigger situation. Just a summary on Chair Powell is this seems to be a little bit hawkish in terms, or excuse me, dovish, a little softer, mainly because I think they're still so dependent on the data that's coming in. So either they understand where the market trends have started to slide, which some of the CPI data has indicated this movement. Again, we're also starting to see some of the market corrections in used cars, most likely the pressure on the housing market, CRE, commercial real estate, that also is playing into this. So I think they are anticipating a much further drop in core inflation, also with general inflation in the next run, which will be about 2 or 3 weeks from now. We'll get our next report. We'll take a look at that. I want to jump over to this tweet right here. This is by Ron Hammond, and let's zoom in on this a little bit because this kind of explains what's happening right now in the House. And just to give you guys an idea, if you're new in the stream today, we're covering two things. One is the FOMC. Powell confirmed a quarter point, has been a little bit dovish, and is anticipating some more moves in the market. Crypto itself, if you look at Bitcoin, outside of Bitcoin dominance, we'll go to those charts in a moment, up slightly and then back nesting in around that 29.2 rate. So this rolls over into the next big situation that is really in front of the crypto markets, and that is this whole issue with the House vote. Now, the House vote is very important because there's two bills, and we talked about that. It's the market structure bill, which is pretty much led by Patrick McHenry, and then you also have the stablecoin bill, also led by both the Agriculture Committee and the Financial Committee. So that one coming off tomorrow. So we've got two bills potentially that could make it to the House floor, one on stablecoins, one on a market structure. But Ron Hammond hit this pretty nicely in reference to awareness. This week in Congress Crypto this week, nearly 5 years after various groups of bipartisan lawmakers got together to work on regulatory framework, we're now at the cusp of Congress moving various crypto bills, regulatory bills, and this is what's on deck. So clarity of payment and stablecoins, that one's coming in. The hang-up still remains the role of state and federal regulators. This is going to be interesting because the New York state regulators are the ones that are interesting here. So just like state regulators with stablecoin frameworks like the New York financial services, and so they split on the Dems versus what's happening with the Republicans. Further into it, all right, so there was another amendment that just got passed. Let's cut to just so you guys know what's happening, we're actually streaming this in. right now. Let's cut over to the House floor. All right, so what's happening here right now is Patrick McHenry is going through these amendments, and these amendments are basically being thrown live into the House floor. This is typically how these bills get structured before they move on. And once that occurs, if the amendment is either struck down or accepted, then it gets incorporated into the overarching bill, and the bill gets moved to the House floor for the general House to vote on it. So back to Ron Hammond here. So Bill 2, Financial Innovation and Tech for the 21st Century Act. This is a market structure bill based off several previous bipartisan bills. It's also unprecedented since it involves two committees. This is the one that is kind of going on right now. For this fight, crypto industry versus skeptic, it's still no means a giveaway to the crypto industry. Good statements here, I think, from Ron. And we've had Ron on before. We'll probably try to get him back on to talk about this. We're obviously going to see some results today from the House. Either it's going to get denied, which will be a big deal, or it is going to make its way to the House for a real vote. If we see that happen, that will be a very big sign for how policymakers are looking at what's happening right now in terms of the possibility of actually getting crypto legislation over to the Senate. A couple other things here. Bill number 3, this was the Blockchain Regulatory Certainty Act. This is the one that was the opposite of the Warren Marshall bill. If you guys have been following, we actually have a whole playlist. If you're on our channel, you go down to our playlist down there on all of our hearings. And there's a variety of hearings that we've broadcasted over the last month and a half that are very critical if you want to learn and get caught up on all this stuff in terms of what bills are applicable, or just tune into us right here. If you are not smashing the like button and you're in here right now, please do that. If you like these kind of videos, a breakdown on these, just to give you guys a quick view on the chart. Bitcoin coming right back after a bottoming out right at the 29.2, so hovering right around the 29.3 on this. Another thing that plays into this is the market sentiment, and we did a video on Doge token, but more importantly on, in general, altcoins and meme coins and what's happening. If you followed what's happening with WorldCoin, you followed maybe a little bit of movement here with X, and also, did that amendment get passed? Yeah, okay, so one more amendment got passed. All right, is that the education one? Yeah, okay, so another amendment they had been debating on the floor right now is one that basically aligns education with investors, saying, okay, we're going to pass this rule that says you have to have, some sort of, and there's been a lot of people that have kind of gone this direction for accredited investing, because if you know how accredited investing works, you have to have a certain wealth or a certain, value when you look at being able to invest in risk assets such as VCs do, much like independent, whether you're an angel startup or something of that nature. That's kind of what was being proposed in the past. That, of course, if we get more education in there. The other thing that was kind of interesting on that as they were doing this, I'm trying to listen into multiple feeds right now, so it's a little crazy. But one thing that they brought up was what I thought was intriguing is the fact that they were starting to pull partisanship over from the Democrats. This was a Republican proposal that we were starting to see Dems start to move to this side. So it's very possible this thing goes to the House floor, and that's a pretty significant thing. Bitcoin continues to move up, and of course, let's take a look at ETH right now. ETH also pulling right against it. If you look at Bitcoin dominance right now, still hovering around 49.89% on all of that. So again, good news for crypto, I think, in general. Not a bad report from the FOMC and Chair Powell, but it's not a great report either. It's not going to send markets to the roof. I think what we're going to be dealing with over the next few days is what's happening on the House floor. If this bill gets passed, and of course we see the stablecoin, which I think is more likelihood of being passed in the long term, this will be over the next 6 weeks. I think we had several scenarios that played out in this. Also, remember, there's one big elephant in the room if these two bills end up in play, and that is the Coinbase lawsuit, of how the SEC is going to be able to deal with this now that we may actually have law coming out within these arrangements. So lot happening right now. Do we still have the House feed? Yeah, are they wrapping? Okay, so it looks like they're still going. Yeah, all right, so okay. All right, so here's what we're going to do, guys. This is what we're going to do. We're going to continue to monitor what's happening on the House floor right now. Looks like they're going to go a little bit later. As that breaks and we get that clip, it's possible we could come back to you with a live stream. Maybe. We'll see. If anything, we'll give you a recap on how this House vote comes out today. First thing tomorrow, so you guys get a full wrap of all that good stuff. Again, thanks for listening in today. It's been a crazy one with what's happening. If you tuned in late, quarter point, anticipated, Chair Powell coming in slightly dovish, looking to data as we go forward. Next FOMC 2 months away, and a very critical CPI coming up next month that we need to watch very closely. We'll keep you all tuned into what's happening over there on that. Of course, if you're not in our Diamond Circle, this is one of the best ways to stay attached to what we're doing, our research, our deep dives, some of our additional content that we do not put out here on the YouTube channel, that you can only get. Our podcast, additional content that I put out, analysis, chart breakdowns. I just did one today on sentiments and sentiment trends that are starting to happen, where we see a lot of these meme tokens and altcoins moving in the next bull run. You don't want to miss that. So just click the link down below. And of course, you can follow me out there on X, @PaulBaron. We'll catch you next time right here on TechPath.